Hey guys, 𝗤𝗙𝗙𝗀𝗧𝗏 here, a popular investor from eToro. In this video, I'm going to be breaking down Warner Bros. Discovery's debt into even more detail. Warner Bros. Discovery are the owners of Harry Potter, The Lord of the Rings, and Friends. They recently merged with Discovery, whose streaming platform Discovery Plus was an outlier among streaming platforms because it was one of the few that were actually profitable. The story here from an investor's perspective is simple. Warner Media, one of the world's largest collections of quality content, has merged with a successful streaming platform and will ultimately create one of the biggest rivals to Netflix. The problem? After merging and forming the new company, they have $50 billion worth of debt, which is why a lot of institutional investors and loads of retail investors won't touch this stock with a 70-foot pole. So what I want to get into is the short-term debt forecast, as well as what I believe the effect of paying off this debt is going to have on the share price. By the way, guys and gals, before we get into it, this is going to be my 100th video. So if you're enjoying these videos, please like and subscribe. And by the way, if you do subscribe, I am only 10 subscribers away. I'm less than 10 subscribers away from 1,000 subscribers. So this might be your last chance to be one of my first 1,000 subscribers. If you are a long-term subscriber already, you might be wondering, why didn't I upload a video last week? I upload one video every week, as you know. Well, the reason I didn't was because I was revising for my CC exam, my Chartered Institute of Securities and Investment exam, specifically my level 3 in International Wealth and Investment Management. A huge shout out to eToro, who actually pay their popular investors $1,000 if they pass this exam. It was going to cost me, it cost me £500 to do, and if I passed, I got nothing. But respect to eToro, they give you a $1,000 reward if you pass the exam. So I am so relieved that I had passed. It also feels really good to be doing this YouTube channel now that I have some actual financial qualifications backing me up. One particular area of this exam that I found super interesting, because it helped me understand Warner Bros. Discovery, is the explanation of notional debt. So what is notional debt? The notional value is the amount you pay interest on, and it's also the amount that you pay back at the end of the term of the loan. If Warner Bros. Discovery's debt was a mortgage, for example, your mortgage might be $300K and you're paying 5% interest, and your term might be 30 years. And so what most people do is they pay the principal and the interest. The principal in this case would be the nominal value, the notional value. And what most people do is they pay the notional and the interest at the same time. So the notional amount gets smaller along the term of the 30 years. What most companies do is they just pay the interest on the loan. They pay the coupon, the interest on the notional value. And then at the end of the term, at the end of the 30 years, they'd pay the $300K. So typically with the debt for companies, there are these dates that come due where you have huge notional payments. There's obviously a huge benefit to doing it this way for a company versus your house. Your house is a liability, so it's not going to be earning you more money as time goes on, but this money that Warner Bros. Discovery has, if they invest it into streaming, well then that money has the potential to compound and actually grow in value. It's an asset. And so even in the house analogy, the $300K house, when you got the notional loan, by the time that you were paying off that $300K all in one go at the end, assuming 2% inflation, would be $164K relative to your income. But this is debt shrinking relative to inflation, whereas I think it's more important when you're analyzing debt of companies to compare it to their free cash flow. Free cash flow is what we use to pay back the debt. And if it's a good business, free cash flow can grow a lot. And so what I'm expecting from Warner Bros. Discovery is that their free cash flow is going to grow by around 5% annually. So to understand this better, rather than looking at the debt as a whole, let's look at two loans specifically. One loan has a notional figure of $7 billion and is due in 2052, while another loan has a notional figure of $4 billion and is due in 2027. The $7 billion loan has an interest rate of 5.14%, and the $4 billion loan has an interest rate of 3.755%. That means we are paying $360 million on the $7 billion loan and $151 million per year on the $4 billion loan. However, as I said earlier in this video, the $4 billion loan, the notional figure, is due in 2027. So even though the $4 billion loan with $151 million per year interest might seem like less of a threat, it's actually a much bigger deal than the $7 billion loan that's due in 2052. However, I think the really interesting thing here is how really high interest rates on government bonds right now are making our debt so much cheaper. If you're Warner Brothers Discovery today and you want to buy back this $4 billion loan, you obviously wouldn't pay $4 billion, the notional value for it. So what you want to know is how much less of that notional value can you buy that loan back for? And by the way, the reason that we wouldn't buy it for $4 billion is if we literally had $4 billion right now in cash, what we do is we put it in a government bond and we get 1% more interest than what we are currently paying in interest on this loan. So basically we could pay the interest for this loan with the interest we got from treasury bills and have some money left over. Basically, what the bank can do that has our loan is they can take some of the notional figure off. This is called the discount to par value. And basically, we could buy it back even cheaper. And therefore, the bank could then invest this money themselves in a government bond. So how much of a discount from 4 billion would you expect on this loan? Well, conveniently for us and working out this, the government bonds right now, the 5-year fixed government bond is 1% more than the interest on this loan. So the minimum discount you would expect from the notional figure, expressed as a decimal, would be 1.01. Over 4 years, that's 1.01 to the power of 4. And so what you do is you take the 4 billion notional figure and divide that by 1.01 to the power of 4, which means the absolute maximum that you would be willing to pay for this loan is 3.84 billion. However, there is also a risk factor to consider because the fact is the government bonds are guaranteed money. So what you want to do is you'd actually pay even less than 3.84 billion for this loan. So guys, armed with this new information of how debt works, I decided to update my sheets, my Google spreadsheets about Warner Brothers Discovery's debt and also simplify them a bit. What I've done is I've taken all the notional debt figures from their debt schedule and I've applied interest to them over the entire course of all the debt's terms. What I've also done is I've discounted these interest payments and these notional figures by 5% annually to compensate for the fact that I expect their free cash flow to grow by 5% annually. This is why in my model, it assumes that the 3 billion that is due in 35 years time is actually going to be 500 million relative to today's money and today's free cash flow. Without this free cash flow discount, the graph looks like this. And I think this is actually more misleading because it makes adjusting it for free cash flow growth really highlights how little that 7 billion is going to be in 2052 compared to the interest and debt payments that we have due today. That $7 billion when it comes round will likely feel more like our interest payments today. By the way, guys, if you want to use this chart, you can just copy and paste it and then you'll be able to edit it. Just don't get too obsessed with financial modeling. I found that the more modeling you do, the more your models become a bit of a black box and a bit of a confirmation bias machine. What's probably happening if you're using tons of models to work out if a stock is a buy is actually the stock is actually bad and you're trying to add models in order to make it look good. The issue with more models guys, is because you keep on adding more and more subjective features. So like me assuming that free cash flow is going to grow by 5%, right now there is only one assumption built into this model. If I was to add more elaborate models, I would be adding assumptions and complexity, and I would no longer know where all those assumptions are. You also get updating fatigue, so over time, when every new financial statement comes out, because you have so many models, it's going to take you a long time to update all of those models. And so over time, your models, your really complicated models that you built, are going to become less and less relevant. With this model and the discounted free cash flow, I can see that our absolute worst year by far is going to be 2027. This moves me nicely onto a question I hate, which is when is the share price going to move in the upward northerly direction? I hate anything technical or subjective in analysis, but there's a big argument for the fact that stocks tend to go up when the big banks and the institutional investors want them to go up. A bit like Nvidia, they have done incredibly well in their earnings, but where they have done it even better is they've gotten all the institutional investors on side. What all the big banks are doing right now is they're putting equity analysis on Nvidia, tons of models about why Nvidia is incredible. And I don't think any of that's going to go away until Nvidia's earnings are definitely flatlining. Having something like the banks on your side is what can really push the capital gains on your stock fast. So thinking like a bank and the sort of clients that they build equity analysis for, what is going to make them look at Warner Brothers Discovery differently? I think their free cash flow over the next few years is going to pay off so much of their legacy debt that it is going to become impossible for them to not put huge valuations on the business. This is going to trigger a correction in the share price, which is going to get the momentum investors involved, and then some more institutional investors, and then any small retail investor that put $50 in and saw that $50 jump to $200 is going to start pouring their life savings into it. And then that will probably be the point at which the stock gets too expensive for me to justify having in my portfolio. When is that point going to be? Well, for me, if I was to guess a time when that would happen, it would be 2028. In 2027, a huge notional figure is going to be paid off, and after that, the interest payments and the notional figures are pretty much below what today's interest rates are. And after 2027, if the free cash flow figure has grown, which is another thing, we will have seen whether the free cash flow can grow by that point. After 2027, if it has grown, we're going to have loads of free cash flow to invest in new intellectual property for Max, which should have grown by that point also. And we'll also be able to do things like share buybacks. So 2028 is my time horizon for when the value of this stock should be unavoidable. For any of you that are unwilling to hold a stock for that amount of time, or if you're thinking of using this money to buy a house, I can't help you. I simply do not believe in investing in stocks for less than 5 years, and I've already been an investor in Warner Bros. Discovery from the point at which it was just Discovery. So I've already been an investor for 2 years. So by the time 2028 rolls around, I would have been holding this stock for 6 years, and I am totally fine with that. But the reason that I am also not waiting to 2028 to hold the stock is because I do not think it necessarily has to move up at that time. I think there are many things that could happen in the short term that just aren't guaranteed to happen. But basically, if their free cash flow was to go up a considerable amount in the short time, they were to get a new sort of IP, or if the Lord of the Rings franchise that's coming out next year is a smash hit, then these are things that could cause the free cash flow to go up even faster, and therefore because that will be proportional to their debt, it will make their debt payments easier to pay. That could cause the share price to go up a hell of a lot faster. The stock could triple this year purely on the basis that they have a 5% growth in free cash flow and achieve profitability. But the thing that we need to do if we want to be rich is